Short Selling Explained by Black Swan Thinking. Most investors are familiar with the old adage, buy low, sell high. It's what's told to anybody who's looking to buy into a security. This is referred to as taking a long position on a stock. This is also the way that most investors will traverse the stock market. On the other hand, short selling is the complete opposite of this. With short selling, the adage of buy low and sell high is flipped. You might be thinking, how is it possible to make a return in this way? It's a little bit more complex than our long position explanation, but goes as follows. When taking a short position on a stock, you don't actually buy the stock. Instead, you borrow it from a broker at its current price under the assumption that the price will fall significantly below what it is currently valued at. Once the share price has fallen to your satisfaction, you will then sell it back to the broker and pocket the difference. So let's look at an example of this in action. Say person 1 owns 10 shares at $100 of Black Swan Co. and person B has just found out that YouTube is going to shut down within the next 2 months. So he decides to take a short position on Black Swan because if YouTube is shut down, Black Swan will not be able to generate any ad revenue from that platform. So person B shorts 10 shares of Black Swan at $100 by borrowing 10 from his broker, who got them from person 1. But this is where short selling becomes more complicated and more risky than traditional long investing. If Black Swan's share price goes from $100 per share to $50 per share, this will be good for person B, as he will be able to sell those 100 shares back to the broker for $500 and keep the other $500. But what if YouTube doesn't shut down and Black Swan's share price goes up to $150? Person B will now owe the broker the increased $50 per share and hence will have lost $500 on his position. But it goes further than that. When you go long on a stock, the return you can make is theoretically infinite, as there really is no hard and fast cap to the rising of a share price. Additionally, the most you can lose is the amount you put in. This is however not the case with short selling. If you short a position, your potential losses are infinite, as the stock can theoretically rise forever, while your potential gains are limited to what you would make if the stock price drops to zero, which is 100%. Furthermore, short selling comes with a few distinct expenses that do not come along with traditional buy and hold investment strategies. Since you're borrowing the security from the broker, you will have to pay that broker an interest rate, just as if you were borrowing money from a bank. The interest rate is determined by the particulars of the stock, and that's just the beginning of the extra expenses that come with short selling. Because the potential losses from a short sell are very high, you will have to let the broker hold a percentage of the share price in your money as collateral in the event that the stock continuously rises. This is called margin, but let's say the stock price doubles and that margin is no longer a sufficient percentage of the stock price to be held as an effective collateral. You will now be subject to something called a margin call, which is basically where you have to add additional funds to the capital already held by the broker to satisfy the broker's need for collateral. Additionally, if the stock you are shorting pays a dividend, you will have to pay that dividend to your broker along with any interest rates as well as any margin calls that may be incurred. All of these complexities make short selling a lot less attractive for individual investors, but there is still a lot of money to be made in short selling, as we've seen recently with Pershing Square's Bill Ackman, making perhaps one of the greatest short sells in history. This was done with an investment instrument called swaps, which is slightly different to traditional short selling, but definitely a topic we will cover in the future. You may also be familiar with the movie The Big Short, which covers the story of Michael Burry and a few other funds who saw the housing market crash of 2008 coming, and also utilized swaps to broker deals with multiple banks. Hey guys, thank you for watching. If you found this video informative at all, please make sure to hit the like button as well as subscribe to the YouTube channel. It does so much for the algorithm and is so appreciated by me. Also, if there's any topic you'd like me to cover in the future, make sure to comment down below and I'll do my best to get to it as soon as possible. Till next time, bye.